Hi there, welcome back to the module on accounting concepts, principles and conventions. In this module, we are going to cover three topics. First, generally accepted accounting principles. Second, commonly used accounting concepts, conventions and principles. And the last topic we are going to discuss is accounting policies and their disclosure requirements. So, let us start with generally accepted accounting principles or GAAP. As you can see on your screen, generally accepted accounting principles are the guidelines for financial accounting. They include accounting standards, concepts and conventions that accountants are expected to follow while preparing financial statements. Now, GAAP standards differ across countries as the policies and the disclosure requirements could vary from country to country. While the disclosure requirements might be different across countries, it is very important to note that the basic accounting concepts and conventions are applicable across all accounting principles, and these provide the guidance to the accountants across the world. In India, for example, the Institute of Chartered Accountants of India or ICAI sets the accounting standards that have to be followed by organizations that are registered and operating in India. The accounting standards applicable in India are commonly called Indian GAAP. Let us now try to understand some of the more important accounting concepts and conventions. The first concept that we are going to look at is what is known as the business entity concept. The key features of this concept are shown on your screen. The business entity concept is a very important concept as it is based on the premise that transactions of a business have to be accounted separately from that of its owners. In other words, the business entity is considered to be distinct and separate from its owners for the purpose of accounting. What is the benefit of this concept? This concept helps in estimating the correct financial condition of the business as the personal transactions of its owners are not mixed up with that of the business transactions. That is why the personal expenses of the owners do not appear in the profit and loss account of the business. If the personal expenses, for example, are paid out of the assets of the business, such payments are treated as drawings in the books of accounts. The second concept that we are going to look at is what is known as the going concern concept. Again, this is one of the fundamental concepts based on which financial statements are prepared. It assumes that the business will continue to operate in the near future without any need or intention on the part of the management to liquidate the business. It is assumed that the organization will realize its assets and settle all its liabilities in the normal course of the business. This concept has particular importance for valuing assets in the balance sheet. It is because of this concept that the organizations are able to defer prepaid expenses such as rent advance or electricity advance or salary advance and allocate depreciation incurred on fixed assets over several years. Remember, if it is known that the business might cease operations soon, which means that it is not a going concern, then the assets and liabilities of that business have to be recorded and estimated differently. Therefore, going concern is an extremely important concept that plays a critical role in how financial statements are prepared and presented to the users. The third concept that we are going to look at is, as you can see on your screen, what is known as the money measurement concept. This concept is also known as materiality concept. Now, according to this concept, only transactions that can be reliably expressed in terms of money or money's worth can be recorded in the books of accounts. Note the use of the term reliably in the definition. The term reliably means that there should be some objective evidence for assigning a particular value to a transaction. This evidence could be invoice or a contract between the buyer and the seller or any other document to support and justify the value that is assigned to a particular transaction. If there are transactions for which values are not known or cannot be reliably estimated or proven, such transactions should not be recorded in the books. This concept is the reason why important factors, business factors such as goodwill, that is internally generated goodwill, or customer loyalty do not get recorded in the books of accounts. However, if the transactions are important enough for the users to know but cannot be quantified in terms of money, such transactions have to be disclosed in the notes to the financial accounts. The fourth concept that we are going to look at is what is known as periodicity concept. According to this concept, financial performance of a business has to be shared with the users on a periodic basis, typically at least once a year. The period of 1 year for which books are prepared is known as the financial year. This concept helps the stakeholders to understand how the business is performing financially and take necessary actions wherever required. The management, for example, can decide that the corrective actions to be taken in the future. The shareholders can also decide whether to sell or hold on to the shares of the business. Lenders can decide whether the business is financially sound or not. Having the financial statements prepared at regular intervals also facilitates easier comparison of results across time periods or over the years. The fifth concept that we are going to look at is what is known as accrual concept. This concept states that the revenue and expenses of a business should be recorded in the period in which they are recognized. Expenses should be recorded when they are incurred, irrespective of whether these expenses have been actually paid in cash or not. For example, at the end of a financial year, if the accountant finds that the salary of the employees for the last month has not yet been paid, the accountant still needs to record the expense in the profit and loss account. This is because the salary expense has been incurred by the business even though cash has not been paid to the employees. Similarly, revenue is recognized in the books in the period in which it is earned and not necessarily when the cash is received from the customer. For example, if a company has a fixed deposit in a bank, the accountant might need to make a provision for the interest due on the fixed deposit even if the interest has not been credited by the bank on the last day of the financial year. So, accrual concept in short ensures that the expenses of a business are matched with the revenue earned in a particular accounting period.